Economic uncertainty is at an all-time high. It's higher today than during the pandemic in 2020, and several times higher than the Great Recession in 2008. In other words, nobody knows what economic turns are coming next from the White House. And that's mostly because of the massive tariffs that Trump has slapped on nearly all American trading partners. The scale of these tariffs took nearly everybody by surprise, and the rollout has been unpredictable to say the least. And that kind of uncertainty has put the Federal Reserve under mounting pressure to lower rates to support the market. A lot of that pressure has come from President Trump himself. He has personally criticized Fed Chair Jerome Powell on Truth Social. In a post on April 21st, Trump called Powell Mr. Too Late, urging him to lower rates now to avoid a slowdown. But Jerome Powell isn't taking that advice, at least not yet. The Fed was cutting rates in mid-2024 as inflation was coming down, but they stopped cutting late last year, and the Fed funds rate has remained flat since January 2025. In December, they reduced the number of anticipated rate cuts in 2025 from 4 down to 2, and the Fed is widely expected to keep rates flat until September. Powell has explained this cautious approach by pointing to uncertainty surrounding Trump's tariffs and how they'll affect prices, calling it a wait-and-see approach until the impact of tariffs is clearer. But why won't the Fed just lower interest rates to support the market? Well, the Fed follows a dual mandate of stable prices and maximum employment to maintain steady economic growth that's not too fast or too slow. Economic expansion naturally ebbs and flows in a process known as the business cycle. It looks like this. During these steeper expansions, the economy is growing, has low unemployment, and usually rising inflation. To keep the economy from overheating, the Fed usually raises rates here. That slows the economy down a bit, inflation cools down, and unemployment might go up. Then during contractions, the economy generally has higher unemployment and low inflation. This is when we can expect rate cuts from the Fed to support the economy. So where do we stand today? The current unemployment rate sits at about 4.4%. That's quite low, and not a cause of concern for the Fed. Remember, one of their dual mandates is maximum employment, and 4 to 5% unemployment is about as low as it gets. However, the unemployment rate has been ticking up a bit since around mid-2022 when it sat at 3.6%. And the high level of uncertainty also has an impact on employment. Let's look back at the chart we opened with, showing economic uncertainty. If we overlay the NFIB 3-month hiring plans and invert it, we can see that uncertainty and hiring are closely linked. The more uncertainty, the less companies plan to hire. That could be a red flag. The extreme level of policy uncertainty we're seeing right now could very well accelerate that uptick in unemployment, putting pressure on the Fed to lower rates sooner than they intended to, in order to make borrowing less expensive so companies can hire more and employment can rise. And as hesitant as they are to lower rates too soon, they do have room to do so. The Fed funds rate currently sits at 4.3%, which is relatively high. That means there's room to cut. If the Fed wants to stabilize markets or cushion a slowdown, they've got the firepower. So if they have the firepower, why don't they use it? Well, there's also the other mandate the Fed has to keep an eye on, inflation. The Fed wants to keep it around 2%, low and steady. That keeps prices relatively stable while allowing the economy to grow. Despite fears that tariffs will raise prices, inflation has actually been falling for the past year or so. But there's an important measure of inflation that already has shot up thanks to tariffs, and that's expected inflation. Just look at this chart of one-year inflation expectations. It shows a massive jump over the past 6 months, as consumers weigh in tariffs on projected price increases. The Fed will be watching closely to see if this is just a transient panic or something else. As soon as prices do start to rise, if that happens, then the odds of a rate increase could also go up. The Fed will be hesitant to overreact or to move too soon because of the risk of recession, but they also don't want to see inflation get out of hand again. As much as Trump wants the Fed to lower rates now, doing so too soon might be a big mistake. It could end up with dual-pronged inflation caused by high tariffs and more consumer spending. So in the near term, we're likely to see a cautious Fed moving slowly, waiting and seeing what happens with unemployment and inflation. But as the tariffs take effect, the Fed could be looking at a clearer picture by their meetings in mid-June or late July, for better or for worse. At Capital.com, we'll continue to post videos keeping you informed on the latest market trends and financial news. Click subscribe to stay tuned. Thanks for watching.